So last Friday, something extraordinary and actually very scary happened. The VIX spiked 50% in one day. As a matter of fact, if we take a look at the VXX ETN, VXX is just an exchange traded note that's based on the VIX. This is the fifth largest spike in history, August 2nd, 2024. You could see that here. Now, you would think that the S&P 500 was down 50% or something. As a matter of fact, that day it was only down 2.5%. And as of now, it is only down 5% from all-time highs, which is a typical pullback. So is this the end of the world? Yes. No, kind of. I'll explain. So essentially what triggered the fear was that the unemployment rate came in at plus 4.3%, which actually is historically still pretty low. But the expected unemployment rate was supposed to come in at 4.1%, so came in much higher than expected. Now, the unemployment rate has been hovering at 4% since May 2024, but this is the first time since it crossed 4% that it came in significantly higher than expected. So what is everybody thinking? Oh my God, the recession is here. As a matter of fact, we might already be in a recession. So if you want to know more, watch the rest of the video. I promise you it's important because I'm going to be telling you exactly when I'm going to be getting out of the market and what type of equities / instruments I'm going to be transitioning into based on these readings. I promise you this will be the most value-packed video that you watch on the subject. Let's get right into it. So I've talked about this time and time again on this channel. You guys that are familiar with this channel know that I think we are going to hit a recession either this year or next year, but I also don't think that one should stay uninvested from the market until certain things happen, and we are going to talk about those certain things. But here's why we might already be in a recession, or here's why you're not going to get alerted when a recession hits. If we take a look at when the 2007 recession hit, the NBER, which is basically the bureau that is responsible for calling a recession or not, they declared that we hit a recession on December 1st, 2008. However, they said that we hit a recession in December 2007. So on December 2008, they told us that last year, December 2007, we actually hit a recession. If you think this is a one-off, let's take it back to 2001. The NBER announced on November 2001 that the U.S. economy entered a recession in March of 2001. So we're talking about a whole, 6-7 months after we were already in a recession. So yes, we might already be in a recession technically at this point, right? Now, obviously, the extent of recessions and how bad they are, that's a whole other topic. But one other thing that I want to show you is called the SHAM rule, S-H-A-M. Named after the person that developed this tool. Her name is Claudia Sahm, and this tool is so effective that the Federal Reserve now uses this as a way for them to track recessions before the NBER actually declares a recession. So if we take a look at the SHAM rule, well, let me tell you what it is. The SHAM rule signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to its low during the previous 12 months. And if we take a look at the current reading for July 2024, it's already above 0.5. It's at 0.53. So we might already be entering the throes of a recession here. So is this a buyable pullback, or is it time to get out of the market? And I did a whole write-up on this last week in our trading floor. By the way, sign up below if you want access to all of my analysis, long-term analysis, my day trades, my option swings, etc. We also trade live every single day as a group, so make sure you sign up below if you want to trade live with me at market open every day. But I put out this analysis here showing that in a bull market, right, if you take the VIX over VIX 3M, so what that means is the current VIX, the current volatility index, divided by the VIX 3M, which is 3 months out, right? So because there is a lot more unknown 3 months out, the natural progression of the VIX 3M is going to be higher than the current VIX because there's a lot more unknown. However, during VIX spikes or during times of real uncertainty in the current term, sometimes the VIX trades higher than the VIX projected 3 months from now, which means that things are perceived in such a volatile manner now that the VIX is higher than it is 3 months from now, right? So when we see these spikes, and this is when the VIX over VIX 3M is above 1, meaning the VIX is higher than it is 3 months from now. We've seen this in a bull market multiple times so far, right? So we saw this in March of 2023. You can see here, this signaled the actual bottom. And the VIX, I don't want to go through every single reason why the VIX spiked during these times, But you can see here in March 2023, VIX over VIX 3M was above 1. That was the bottom. You can see here back in November 2023, that was another bottom. You can see here back in April when we had the last pullback in the market, the last 5% pullback, right? We had a spike. That was the bottom, and we are seeing it now again. So is this the bottom here? Well, we use a couple of things to help us. One, the length of the average bull market. So if this bull market were to die today, right? If this were to turn into a bear market, this would be tied for the shortest bull market in history. The average bull market, the average length of a bull market is actually 61 months, and we are now in 21-month territory. Second thing, a little more minor, but the fact that we're in an election year, August is bullish 100% of the time, going back for the last 32 years in an election year. Now, this here might be the most important and simple chart that I put together recently, but it shows when the first Fed rate cut happened during a hiking cycle in a bull market, and what happened after the first rate cut and what happened to the market as well as to the economy. You can see here the first rate cut was January 3rd, 2001. The market from that point forward dropped an additional 43% as the economy was thrown into a recession. Obviously, as I showed you earlier, the recession was declared after the fact, 6 or 7 months after the fact. Same thing happened in 2007. The first rate cut was September 18th, 2007. The market fell 57% after that, and then a recession was declared in December 2008. A recession was declared for the year of December 2007. Now, we have the next FOMC meeting, September 18th, 2024. Is this going to be the first rate cut? As of now, because of that higher than expected unemployment rate, what we saw here was that the market is now anticipating a higher chance for a 50 basis point rate cut. It's still lower than the 25 basis point rate cut, as you see here, but this went from 6% to 22% after the higher than projected unemployment rate. So some are even projecting a 50 basis point rate cut in September, but most are projecting a 25 basis point rate cut in September. There is something that can throw an entire wrench on this, and I think will really be dangerous for the economy. And I'll tell you what it is. And that is the CPI that is being released on October 14th, which as of the time of this recording is 2 weeks from now. The projected, we don't have a forecast yet, but the previous was 3%. So if CPI comes in higher than expected, then I think there's no chance that a Fed actually does a rate cut. If the CPI comes in at 2 point anything percent, then I think that September we are going to get our first rate cut. Now, what I think will happen then is I think both of these yield curves will uninvert, the 10-year and 2-year, as well as the 10-year and 3-month. And at that point, when both of those yield curves uninvert, as you can see in history, that along with the unemployment rate is what is going to signal that we are in a recession. It is what is going to allow the Fed to make that first rate cut. And what are we going to do? Get the fuck out of Dodge is what we're going to do. So I know there's some conflicting stuff here. So let me break it down for you in summary, and then I'll give you some of my positional details here. But in summary, I think that this could be the end of, or near the end of the pullback / correction that we see here. As you know, we tend to average 3 - 5% pullbacks in the S&P 500 a year. This is now the second one. The first one was back in April. Pullbacks are actually quite healthy. However, if the next CPI comes in higher than expected and doesn't come in at 2.9% or better, I don't think that the Fed is actually going to cut in September, and I think a lot of people's hopes will be crushed at that point. Also, if the next unemployment report comes in higher than expected, this is what's going to be really crushing in terms of the how bad the recession is going to get, right? If the CPI comes in higher than expected, but unemployment comes in higher than expected, the Fed cannot actually cut rates because we are still dealing with inflation. This is actually what causes recessions and why we've never had a soft landing. Because trying to tamp down inflation while keeping unemployment under control is impossible to do. I mean, maybe it's possible, but so far it's been impossible, right? So I have no reason to believe that it's possible. So if CPI comes in higher than expected and unemployment comes in higher than expected, then I think that is going to cause a more severe recession than we thought. If CPI comes in as expected or lower than expected, then I think the Fed has clear runway to cut in September. And once they cut, then you're going to see bond yields, especially short-term bond yields, get slammed, and these bond yield curves will uninvert. And at that point, I will be looking to potentially get out of the market. Obviously, it's all data dependent. Now, oddly enough, you might be asking yourself, what if the Fed doesn't cut in September? Does the market crash? Well, remember that we were expected to get 6 rate cuts this year, and we haven't gotten one yet. What did the market do? It just continued to go up. As a matter of fact, it broke record after record. I know now seems like the end of the world. It's only been minus 5%, but we have gone almost an entire year without a minus 2% day on the S&P 500. That is top 3 all time. So oddly enough, if the Fed doesn't cut, I think the market can continue higher. Now, in terms of how I'm positioning myself, as I said, if you want all of my real-time alerts, make sure you sign up below. We started scaling into TLT back in November. TLT is the bond ETF, right? And you can see now that we are getting spikes in bond ETFs as yields continue to get slammed. And I think that it is time, at least in my point of view, this is not financial advice, but if we are getting closer and closer to a cut, you could see that big money is now starting to come into bond ETFs once again. This right here is not a mistake. Where's all that money coming out of the stock market during the sell-off last week? Well, it's being poured into bonds. I'm not saying everyone exited the stock market, but I'm saying at least last week, there was quite a significant outflow out of the stock market. Where's it going to go into? Obviously, the bond market. So if we do get a cut, I think that it will be time to position even heavier into bond ETFs. Depending on your risk tolerance, sure, you can utilize something more leveraged like a TMF, but I think that bonds are going to yield a double-digit return next year and thereafter, because right now, if you were locking in that 5%, well, not anymore, but if you did lock in that 5% dividend or that 5% treasury yield, and the value of those bonds or bond ETFs rise because the fact that bond yields are dropping, well, you're capturing that 5% as well as the equity or the rise in price of your treasuries or bond ETFs. Now, in terms of the indices themselves, I really don't hesitate to buy indices when they're down 10%. So QQQ, which is the NASDAQ, is down 10%. I have made it a habit over the last 20 years to always buy the indices at minus 10%. I don't care what's going to happen, because at the end of the day, you cannot really predict exactly when the black swan is going to happen, right? So for me, if you look at history and you buy every single 10% correction on the indices, you will fare a lot better than someone who just buys randomly and doesn't go in heavier when the market drops in more significantly, right? Because minus 10%, you only really get that once a year. You don't get that a ton of times. So, when the market does correct minus 10% or more, I tend to buy in heavier on both the S&P 500 as well as the NASDAQ for the very long term. This is not a swing trade. Now, you can see that some of the semiconductors and semiconductor ETFs actually hit a bear market. So I don't mind picking up semis here. We all knew that there would be a bust cycle, as there is in every single industry, right? So this is AI's first bust cycle here. This is the first bear market that we've seen for the AI bubble. So I'm happy to buy this, especially if we still think that this is the future, just needed a major correction after such an exuberant rally. So things such as NVIDIA, Broadcom, SOXL, SOXX, I don't mind picking these things up for the long term. Again, none of this is short term. If you are short term, turn this off now. I think Amazon had an extreme overreaction to a slight miss in revenue, especially when it is generating almost $148 billion in one quarter. And I did post this in the trading floor as well, but Amazon cash flows continue to increase quarter over quarter from $7 billion all the way to almost $53 billion now in Q2 of 2024. Also, there's a whole bunch of technical reasons to just pick up Amazon here. I'm not going to get into all of that. If you want all of my analysis, like I said, click the link in the description below. But anyway, traders, I hope this helped. As I said, I think that we can find a technical bottom here. I think if the Fed does cut in September, I will be looking to potentially exit the market at that point. If the Fed doesn't cut in September, then I think that surprisingly enough, the market rally can continue going. I don't think we'll get a heads up on if we hit a recession or not. There is a possibility that we are in one right now. And I would monitor the yield curves like a hawk, the ones that I told you about, because when those uninvert, then we are closer to a recession than ever. Anyway, stay tuned to this channel for more updates as more data comes out and I bring you my analysis. I hope you guys appreciate this. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.